So, Greg, I want to pick your brain on this increase in interest rate. Like, where do you see the market going? Like, is that something as investors we should worry about? I mean, it's like the interest rate is hovering around 7%. So that like directly affects the real estate investors, like especially the residential real estate investors. And we did notice a dip in the market like November, December. I think it kind of like last couple of months it's gone up. But I'm curious, what are your thoughts on that? Where do you see the market going this year and like next couple of years?
Well, I'm looking at everybody on this thing, and I think probably all of you have never seen rates higher than they are now. When I started in the business, rates were 9 and 10%. So there's deals done at every rate level in every economic environment. In 2009, I went through 2009. I had $40 million worth of property in 2009 when the bottom fell out, and in construction loans, and I was paying 9%, 9.5% interest on all those. I had hundreds of thousands of dollars a month going out in interest payments alone, and I could not sell and I could not refinance. So I had to work all those deals out with the banks, and I did. I had money and I had, all that, so I was good. But I've been through it and I've seen it. There's always deals to be done in every market. Here's the key. You need to know the top. It's more important to know the top than the bottom. You've got to know where the top was. And the top was, December of 2021. That was the peak of the market. That was the top. And we've had a little flutters here and there, but we are in a rising rate environment. Inflation is a problem. So here's the key. The Fed is going to tell you when the all clear signal is when you get that green flag and it's time to go. And that's going to be when inflation is back down near their 2% target. So they're getting ready to raise rates again. They might go 50 basis points. That puts pressure on banks and credit. And then the 10-year responds accordingly, which drives mortgage rates. So, we're going to continue to see pressure in the real estate market because of the levels that the property, went to, those distorted levels we saw over the last 2 years. That's not normal. That's not ordinary. And you may not ever see that again. So you just need to understand that, and you need to lead the market down. So you just need to make sure that the deals work with today's interest rates. And you got to use interest rates as the benchmark for what an investor can do with that property, whether it's cash flow, whether it's a flip, whatever it is. And, that's why the housing market has so much pressure on it right now, because people that refinanced and, 3%, 2.5%, 3% mortgages, it doesn't make sense for them to sell right now. There's no inventory, values have gone down, and they'll never get another mortgage rate like that again, probably. And I'm not going to say never, you just never know what could happen. But right now, rates are still rising. The economy is still in a bad spot because of inflation. And until inflation is under control, and I'm talking about, food, housing, cars, all of the things that matter to all of us that are on this call right now and things that we spend every day, I haven't seen a thing come down. It seems like everything is still going up. And, gas is getting ready to go up again. And, the Fed is recognizing that, today Powell spoke and he's recognizing that they're going to have to raise rates higher, faster, and stay there longer to get, this thing in check. And, this is kind of all new territory. So nobody really knows, but, all I know is you just have to reprice based on today's rates, and you have to hold your guns because, at the end of the day, it's all about, finance. The way a deal happens, it's the cost of the capital, the availability of the capital, and that end buyer. What can they do with the property, and can they get some appreciation going forward? So in a bull market, in housing or whatever, you want to lead that market up. So if you sold for 200 yesterday and you're in a bull market, sell for 225 today, then 250, then 275 till you reach pushback. Now we're in a declining market. So if you bought for 300 yesterday, now you're offering 250. Then you're going to offer 200. Then it's going to be 175. So you just need to pay attention to the market, see where the demand is, and lead that market, whether it's going up or down. And, there's still pockets that are getting multiple offers and stuff is selling in days. There are still that happening. So you need to understand where is that happening in your market, and you need to be ahead of those deals. And then, in the commercial sector, housing is huge. So builders are going to be still be looking for land because they can reset and price accordingly because construction costs have come down a little bit. So once they work through their inventory and get it off the books, they've got to keep the machine moving. They're public companies trying to stay employed, so they want to keep inventory going. So they're going to be looking for land to build on. There's rent demand everywhere. So multifamily builders are still building. And, commercial is the biggest area where, that's kind of the trickiest component right now, where there's, more oversupply than any other sector. So, hopefully that answers it. But right now, higher rates for longer. It's going to continue to keep pressure on the housing market. Just be smart and understand what the pricing should be based on current rates, and expect the rates to continue to go higher.
Like, let's say if I was looking to buy a property, would you price it at the interest rate right now? Let's say at 6.5%, for example, on 30-year fixed that somebody's able to get, or would you anticipate the interest rate going up and price it based on that? Because if you're going to be selling a property in 3, 4, 6 months from now, the interest rate might be higher. How would you price that asset?
Yeah, so you have to expect the rate to go higher, in the short term, but it could potentially come down and reset in the long term. So, 3 to 5 years, we could be looking at interest rates coming back down, and they're going to bounce, percentage here or there. Mortgage rates 6 to 7%, maybe we'll get up to 9, who knows. In order to correct the housing market, you need 9, 10% in mortgage rates. I mean, that's where it's got to be to bring the housing market to a halt, to really correct prices, because prices are way out of proportion to where they need to be, and that's why the market is so imbalanced. But yeah, you need to plan on a higher rate 3 to 6 months from now, 1 year from now. 3 to 5 years, you can expect rates to get, to come down a little bit.
I'm curious, you mentioned like the interest rate could, for it to get to 9 to 10% before the housing market comes to. Do you see us getting to that point this year? I mean, that like just the thought of interest rate going to 9, 10%, I mean, that would freak out a lot of people. I'm curious, like if you see that, and how could an investor start preparing for that if that were to happen?
Well, I mean, that's not like imminent, but we're close. We've gone from 2 to 7, 2.5 to 7. So to go from 7 to 10, that's a lot less real estate to close than going from 2 to 7. So, you can't really plan for it because it hasn't happened. You just got to understand your strategy. So if you're assigning, in wholesaling, then who's your end buyer? What are they willing to pay? And keep it simple. If you're going to flip, if you're going to buy a property, renovate it and flip it, then you need to know how long is that going to take me? And then yes, you need to plan for rates are going up. That means the value of what I can sell this for is going to be less a year from now as rates go up than right now. So you have to buy for less. So that's kind of how you have to factor that. And there's another strategy I'm going to share with you here that'll mitigate all that in a minute. But so that's your short term. And then if you're longer term, flipping, maybe it's a year out, you still have to expect rates to go up, but who knows? Nobody knows where the rates are going to be. So you want to make sure you've got multiple exit strategies that you can either rent, owner finance, lease option, so you've got multiple exits in case rates do go up and nobody can buy the property. So you want to make sure that you're not in a hard money loan that you can't afford if you can't sell. That's how you get under pressure, and that's how, bad things happen. And then if you're long-term and you're renting, income producing property and you're renting it out, you can pay whatever you want as long as the property covers the debt service and returns. If you have to put a down payment, what you're looking for on that down payment, whatever you want to make, if it's 10%, 5%, whatever you want to make on your money, you need to make sure that it can pay the debt service, all the income, you've got a little bit for reserves, and it returns on that, down payment, whether you're borrowing it or using your own money, to satisfy that requirement. And, then you got to understand that you probably won't be able to refinance in the near term because values are going to continue to go down, rates are going to go up. So you're not going to pull your equity out anytime soon. So you may have to look at a 3 to 5 year period if you're looking at rental properties, BRRRR strategy, that kind of thing.